Okay, another big change that has a number of different facets to it is with charitable contributions and charitable deductions. So we've got a number of things here. We've got a floor on charitable contributions coming up in the future. We've got, you can take a standard deduction. This was something that we had a few years ago. We're back to having that. Again, if you don't itemize, you can take a standard deduction for charity. And Meredith, can you kind of just go through some of these provisions and how maybe we can plan, because some of these things happen in 25, some of them happen in 26. Go for it.
Yeah, so in 2025, there's really no changes to charitable contributions. If you itemize, you still get them. There's no floor in 2025. In 2026, if you're an itemizer and you have charitable contributions of, let's say, $1,000, there is a 0.5% of your adjusted gross income, technically your modified adjusted gross income, but we'll just say adjusted gross income, that is a floor, meaning you don't get a deduction for that charitable contribution of that portion. So if you had a $1,000 charitable donation you made, your AGI was $100, that means the first $500 of that charitable contribution is not able to be itemized. You would only get a $500 deduction. So they put this floor in place effective 1/1/26. So 2025, if you itemize, no issues. 1/1/26, you're going to start losing some of your charitable contributions. Dan also mentioned a standard deduction for donations. So for those of you who do not itemize, starting in 2026, you are eligible for $1,000 per person, so $2,000 for a married filing joint, additional standard deductions for qualified charitable organization donations. So going forward, do some planning thoughts for 2026 on that front. If you don't itemize historically, but you give to charity, make sure you're pulling those receipts as you get them, keeping track of them, so that way you're not scrambling at your end next year trying to find all of those. As far as some thoughts about what to do right now in 2025 for yourself or any of your clients, think about bunching your contributions. So if you historically give a bunch of contributions at the end of 2025 and the beginning of 2026, and you're concerned about this floor and losing some of your charitable contributions that you may not itemize next year, consider bunching them here in 2025 so you get the most of your deductions. So if you give historically in December and January, perhaps consider just giving it all at December 31st. Another thought is working with your investment advisors on a donor advised fund. So if you've historically thought about this, they have lowered some limits to make it a little more easier to do, but that's something you can consider to do is you fund that here in 25, you get the charitable contribution in 25, but that money doesn't leave the donor advised fund until you're ready for it to leave. And you're saying, okay, I want in 2027 this to head here. You get the deduction in 25, the money can grow tax-free, and then you can donate it in 27, 28, 29, etc. The other thought is if you are over the age and you're taking RMDs out of your IRAs, or you're taking distributions from there, you could do a qualified charitable distribution from there. That way, the taxable IRA actually doesn't wind up increasing your adjusted gross income, but you don't get the deduction on itemized because you're getting it above the line by not having the 1099-R IRA distribution reported.
Okay, we're going to stick with this itemized versus standard deduction issue here for a little bit. Can you, I know there's some changes to the standard deduction in general. Can you just walk us through some of those things?
Sure. So the standard deduction was supposed to sunset and go back to the lower rates that they were historically pre-Tax Cut and Job Act. That, again, that has been made permanent, as Robin said, as permanent as it can be. So the higher standard deduction rates are continuing on. They did also, kibosh permanent personal exemptions. They're gone for now as well. So that's why the higher standard deductions are in place. We talked about the charitable deductions that will be additional to standard in 2026. In 2025, they have put in a enhanced senior deduction as place. You might have been seeing in the news that they were trying to say no tax on Social Security. Well, that didn't happen. Social Security is still taxable, but they have put this enhanced senior deduction in place. There is a threshold. I believe it goes up to $150,000 is where the threshold is, where it starts to eliminate. This is in fact for 25 to 28, so this one does sunset. It's not permanent. They've also put in place a car loan interest deduction. So if you have a personal car, personal passenger car that you bought that in 2025, that was final assembled in the United States, and you have a loan that was in place on the loan after 12/31/24, you are eligible for up to $10,000 of interest deductions, but that has a limit of $200,000 as your adjusted gross income threshold for that. So if you go over that, that will eliminate fairly quickly. And then also, as Josh talked about previously, for those employees that have no tax on tips, no tax on overtime, that also is where this is going into effect on a personal return as the standard deductions. They currently have a draft form out. It is called a Schedule 1A. And this is the additional standard deductions that they have put in law, and it goes into another line on the tax return. So I think maybe some of us recall that the Tax Cuts and Jobs Act was pitched to us as it was simplifying tax. We keep adding tax forms here. It's not a postcard filing.
Okay, I've got at least two more questions about this itemized versus standard thing, so we're going to keep going here. There is the state and tax and local tax deduction, SALT, in the vernacular, was a big deal. That had reduced in the Tax Cut and Jobs Act, so you're only getting $10,000. That has changed. Can you talk about that, the timing of that, and maybe how that can interplay with some of these other itemized deductions we were talking about?
Sure. So there was a SALT cap put in place with the Tax Cuts and Jobs Act that said you can only take a $10,000 deduction for any state, local taxes you pay. So that included your real estate taxes, your state taxes, your local taxes, any LSC taxes, anything that you said. So it was very easy to get to $10,000 for your state and local taxes paid for itemized deductions. So here with the One Big Beautiful Bill, they have upped that to $40,000, but they have put, of course, a threshold based on adjusted gross income. So once you hit $500,000 of adjusted gross income for a married filing joint taxpayer, it will start to reduce by 30% per dollar. So by $600,000, you'll be back down to the cap of $10,000. You don't go lower than $10,000. So if your adjusted gross income is $1 million, you will still get a $10,000 state and local tax deduction, itemized deduction. So it won't go lower than $10,000, but it could be as high as $40,000. This goes into effect here in 2025. So that's something to be, taken in effect if you're a business owner that passes through to your personal return. Depreciation we talked about. So if you have the opportunity to reduce your business income down to zero, and you can keep it under your $500,000 personal AGI, that's great. You can have your state and local tax deduction up to $40,000. So if you pay quarterly estimates, you'll probably want to get that fourth quarter Pennsylvania estimate paid by December 31st this year, so you get you can get the state and local tax deduction for that. Yeah. I guess also on the caveat off of it still is for those that are over the threshold still, that we're still being capped at $10,000, and you own a pass-through business. If you do business in any state that has a pass-through entity tax, you can always look at that to have an S corporate partnership pay the tax on your behalf. They get the deduction, doesn't pass through to you individually. Unfortunately, Pennsylvania doesn't have one of those though, so if you're doing business in other states, that might be something to consider.
Yeah, the other thing I thought of with the increased state and local tax is with charitable contributions. If there's a lot of people who used to itemize, 10 years ago, but haven't itemized recently because the tax limit's down to $10,000, which is an itemized deduction. But now, if you're in that range, you might be able to increase some deductions. You can get the higher SALT limit this year without the floor on charity.
Lots of tax planning to do.
Yep. Okay. last question, I think, on itemized deductions. There had been, you know, people would talk about the piece limitation and the PEASE, not PEACE. And I don't know that a whole lot of people know what that meant, but that went away. But it went away and it's kind of back. It's just named something different and it's calculated a little differently. Can you talk about some limitations on itemized deductions?
Sure, so I actually had to look it up to see when the piece limitations went into effect. And that was in 1991. I personally wasn't practicing tax law at that point in time. But it was 1991. It actually was phased out in 2010, and it came back in 2012. So they put itemized deductions were again reduced. Essentially, it was considered a surtax, essentially, on itemized deductions. It limited it by 3%. And it was, if I mention them, it was miscellaneous itemized deductions, which we all know have been gone since 2017. They're not coming back. Those were limited by piece. Mortgage interest that you could deduct. Well, those are still, the mortgage interest is still limited. We didn't talk about that because it hasn't changed. But under the current law, you can only take mortgage interest expense on the first $750,000 of your mortgage. So if you have a mortgage of $1 million on your property, you actually only can take up interest up to $750,000 of it. So a calculation has to be done to limit it there. So while piece is gone, there's components that are still limiting your itemized deductions now. Salt, we just talked about that. You know, salt tax used to be limited by the piece limitation. Well, we have a cap in place on the salt, so that's being limited. Charitable contributions also was limited when we had a piece. Now we have a floor in place. So essentially, yes, Dan, it's renamed to be something else now. It's now a 2/37 calculation you have to do. Essentially, if you're in the highest tax bracket, your contributions are limited to 35%, essentially effective tax rate. You don't get the 37%.
Does that start in 26?
2026.
Yeah. All right, we'll give Meredith